Imagine this. The price of silver that dictates your smartphone, EV batteries, solar panels, and even critical defense technologies isn't actually decided in London or New York, as most investors believe. What if I told you that a city you've likely never considered, Shanghai, holds a hidden, almost invisible grip over global silver pricing? Every day, billions of dollars worth of silver contracts are being traded on the Shanghai Futures Exchange, SHFE, with physical deliveries so massive they dwarf the numbers reported by Western markets. And here's the kicker. The moves made on SHFE ripple across the world silently, triggering algorithmic trading, influencing COMEX prices, and even setting investor sentiment without a single headline. Most investors focus on the famous exchanges, COMEX, LBMA, New York, but they're missing the real driver behind silver's daily swings. The gap between perception and reality is staggering, and failing to see it could cost investors dearly. In this video, we'll uncover the hidden mechanisms of SHFE, explore how China's voracious physical demand dominates global flows, and reveal why understanding Shanghai might be the single most important factor for silver investors in 2026. The global silver stage, COMEX versus SHFE. You've probably been taught that the price of silver, the same silver used in solar panels, smartphones, and even cutting-edge medical equipment, is dictated by London or New York. COMEX in New York and LBMA in London have long been considered the global arbiters of precious metal prices. Charts flash on Bloomberg terminals, analysts quote the daily silver price, and millions of investors act on these numbers as if they are absolute truths. But what if I told you that this picture is only half the story? That while your screen flashes COMEX numbers in green or red, a silent giant in Shanghai is quietly steering the market in ways most of the world doesn't see? This isn't some conspiracy theory, it's a matter of physical reality versus perception. COMEX, despite its fame, is largely a paper market, dominated by futures contracts that may or may not end in actual delivery. Traders speculate, hedge, and settle contracts on margin. The volume is massive, yes, but it's a volume often detached from physical silver. Enter the Shanghai Futures Exchange, or SHFE. Established in 1999, SHFE has grown into China's central hub for commodities futures trading, including silver. What sets it apart isn't just size, it's how the market operates, and more importantly, the massive physical deliveries that actually leave warehouses in China. Let's break this down. COMEX, the Western giant. COMEX is famous, and for a reason. It has been the benchmark for global silver pricing for decades. Traders around the world watch COMEX prices like hawks. Its contracts are liquid, its market hours align with global financial centers, and its data is transparent. However, COMEX has a fundamental limitation. It is a paper-based market. That means the majority of silver traded never actually changes hands physically. Traders often buy and sell contracts purely for speculation or hedging purposes. Delivery is possible, but it is the exception rather than the rule. Consider this. A single COMEX contract represents 5,000 troy ounces of silver. Hundreds of thousands of these contracts trade daily, but the amount of silver physically delivered is often less than 5% of total trading volume. That creates a disconnect between perceived price and real-world supply and demand. For decades, this model worked. COMEX prices were treated as the global standard. Analysts would compare the London Fix, the LBMA prices, and COMEX, assuming these numbers accurately reflected global supply and demand. But the world has changed. SHFE, the silent influencer. While the Western world fixates on COMEX, Shanghai quietly built a system that emphasizes physical settlement first. In other words, SHFE contracts are designed to ensure real silver is delivered, not just traded on paper. China's industrial appetite is immense. Every year, the country consumes hundreds of millions of ounces of silver for industrial use, from solar panels powering millions of homes to electronics that run smartphones, EVs, and 5G networks. SHFE is the primary platform where much of this silver flows, physically and legally, into the market. What's astonishing is the scale. On many trading days, SHFE's physical delivery volume dwarfs COMEX's total physical delivery, sometimes by a factor of 10 or more. Yet, most global investors never see this. They continue reacting to COMEX prices, while Shanghai is quietly setting the real market tone. Think about that for a moment. A market you have barely heard about because it was not in your Bloomberg terminal is shaping the price of the silver that powers your life. And when SHFE moves, COMEX eventually follows, often with a lag. Why the West misses it? Part of the reason for this oversight is visibility. SHFE is not as transparent as COMEX in every respect. Trading is heavily influenced by Chinese regulations, capital controls, and domestic liquidity flows. Foreign investors cannot always participate freely. This closed-loop system has two effects. It insulates Shanghai from short-term speculative shocks that can dominate Western markets. It amplifies physical market realities, because when silver is bought or sold in Shanghai, it usually corresponds to actual production, consumption, or storage changes. Meanwhile, in the West, prices can swing wildly on paper contracts, headlines, and sentiment, even when the physical market remains stable. The arbitrage paradox. And one of the most fascinating aspects of this dynamic is the arbitrage paradox. Traders occasionally notice that SHFE and COMEX prices diverge, sometimes by more than $1 per ounce. In theory, this should create an arbitrage opportunity. Buy silver cheap in one market, sell high in the other. But due to capital controls and logistical limitations, this is not always possible for Western traders. As a result, the Western market often ends up adjusting to Shanghai's price rather than the other way around. Over time, SHFE's physical realities, demand, supply, and delivery, dictate global prices, while COMEX acts more like a reflected echo of Shanghai's moves. A concrete example. In 2024, SHFE saw record delivery volumes, signaling immense physical demand from Chinese industry. COMEX initially remained stable, but within days, global silver prices surged, reflecting the real supply-demand imbalance initiated in Shanghai. Understanding the scale. To truly grasp SHFE's influence, consider the numbers. COMEX daily trading volume, roughly 150 million ounces, mostly paper. SHFE daily physical delivery can exceed 200 million ounces with significant daily settlements in warehouses. China's annual silver consumption, over 200 million ounces for industrial use alone, with additional investment demand through bars and ETFs. These figures illustrate a simple truth. Shanghai is not just a participant, it is a market mover, quietly dictating the terms of global silver. So, what have we learned so far? COMEX is famous, liquid, and often considered the global benchmark, but most of its activity is paper-based. SHFE, though less known, prioritizes physical settlement, and its trading volumes and deliveries often surpass COMEX in real-world impact. The West often overlooks SHFE due to visibility, access restrictions, and regulatory opacity. Yet, Shanghai's influence is silently driving global silver prices. Arbitrage and price discrepancies tend to resolve in favor of SHFE's physical market reality, making it the true unseen arbiter. China's physical thirst. The demand dynamo, we uncovered the hidden force of Shanghai, the SHFE, quietly dictating global silver prices while the world stares at COMEX charts. But why does Shanghai wield such influence? The answer is simple. China's insatiable demand for physical silver. Every ounce of silver bought or delivered in Shanghai represents a tangible demand. Industrial, technological, or investment-driven. This is no paper game. Unlike COMEX, where most contracts never leave a ledger, SHFE transactions often translate into real-world silver moving into factories, vaults, and investor hands. Let's break this down. Industrial demand, the backbone of Chinese silver consumption. Silver is not just a shiny metal for jewelry, it's an industrial powerhouse. Its unique properties make it indispensable in solar panels. China dominates the global photovoltaic market. Silver is a critical conductor in solar cells, responsible for transporting electrons efficiently. Each solar panel requires grams of silver. Millions of panels mean millions of ounces. Electronics and semiconductors, smartphones, computers, 5G equipment, and circuit boards rely on silver for superior conductivity. China produces billions of devices annually. Electric vehicles, EVs, silver is used in battery components, motors, and connectors. With China leading EV production, demand is staggering. Medical and industrial applications. Antibacterial coatings, mirrors, and specialized instruments all require silver. To put this in perspective, in 2025, China consumed over 200 million ounces of silver just for industrial use, a figure larger than the total annual physical delivery in COMEX. Every time a manufacturer in Shenzhen or Guangzhou orders silver through SHFE, it's physically allocated, often shipped and stored. These transactions create actual supply pressure, unlike paper contracts on Western exchanges where silver may never leave a warehouse. Investment demand, a cultural and financial phenomenon. Industrial use is only part of the story. China's citizens have a deep cultural and financial affinity for precious metals, particularly silver. Historically, silver has been seen as a store of wealth and hedge against inflation. This manifests in multiple ways. Silver bars and coins. Chinese investors buy millions of ounces of minted silver annually. Local mints in Shanghai and Shenzhen report record sales, especially during economic uncertainty. Exchange-traded funds, ETFs. The Shanghai Gold Exchange and other platforms allow investors to hold silver-backed ETFs, increasing formal investment demand. Wealth preservation. Amid global financial uncertainty, Chinese investors prefer tangible assets over fiat currency or speculative instruments. Unlike Western markets, where paper trading dominates investment behavior, in China, physical possession is key. This creates an enormous pull on silver and SHFE, directly influencing pricing. The disconnect with Western markets, here's where the story gets fascinating. The West continues to watch COMEX for price cues. Headlines trumpet gains or losses in the global silver market, but often they ignore the physical reality in Shanghai. On many days, SHFE's physical deliveries exceed COMEX's total daily trading volume, yet these numbers are underreported internationally. Price spikes driven by real demand in China may appear delayed or muted in COMEX reporting, creating a temporary disconnect. Sophisticated investors and algorithms eventually reconcile these differences, but the initial price driver always starts in Shanghai. This disconnect is crucial. If you're only looking at COMEX, you're reacting to the echo, not the source. By the time Western investors recognize the surge in silver prices, the physical demand has already shifted market dynamics, creating late entry risk. Case study: SHFE physical delivery surges in 2024. Let's look at a concrete example. In March 2024, SHFE recorded record-breaking physical silver deliveries, fueled by a combination of industrial orders for solar panel production and retail investment spikes. Initially, COMEX prices barely moved. Traders assumed the market was stable, but within days, global silver prices surged by over $2 per ounce. Hedge funds scrambled to adjust positions. Algorithmic trading systems, monitoring SHFE volumes, triggered a cascade of buy orders in Europe and New York. This scenario perfectly illustrates the invisible hand of Shanghai. The real driver was physical demand in China, but global markets only reacted after the fact. The scale of China's demand. Numbers help us visualize the magnitude. Industrial demand, 200 plus million ounces annually. Investment demand, 50, 100 million ounces, fluctuating with economic sentiment. It's SHFE physical deliveries, often 10x larger than COMEX physical settlements on busy days. In total, China accounts for nearly half of global silver consumption, and SHFE is the conduit that channels this demand directly into the global market. The arbitrage effect, again, but with a twist. The West might wonder, can't we arbitrage between Shanghai and COMEX? In theory, yes. Price differences between the two markets create opportunities. But in practice, capital controls limit foreign access to SHFE. Physical shipping constraints make real arbitrage difficult. Most Western traders are limited to paper contracts, while the real supply-demand imbalance plays out in Shanghai. As a result, SHFE acts as the price anchor and Western markets adjust secondarily. This is the reverse of conventional wisdom, where COMEX is supposed to lead price discovery. The invisible demand drivers. It's not just industrial corporations or retail investors. Other forces amplify SHFE's influence. Chinese banks and wealth management products increasingly hold silver as part of asset-backed portfolios. Government strategic stockpiles. China occasionally increases silver reserves to hedge against market volatility or industrial shortages. Private high net worth investors. Buying physical silver bars in bulk creates sudden spikes in SHFE delivery volumes, unnoticed by the West. Each of these factors creates supply pressure that is unique to SHFE and largely invisible to COMEX-based traders. Why this matters to global investors in 2026? If you're an investor relying on COMEX numbers alone, you're flying blind. Understanding SHFE and China's silver demand is now essential. Here's why. Price shocks. Unexpected surges or drops in SHFE deliveries can trigger global market volatility. Investment strategy. Accurate timing of entry and exit points requires monitoring Shanghai's physical data. Risk management. Ignoring China's demand can leave investors exposed to sudden supply-demand imbalances. Future trends. Industrial expansion, solar growth, EV proliferation, and wealth management all suggest continued growth in SHFE influence. Simply put, Shanghai is not just another market. It is the heartbeat of global silver, and ignoring it is no longer an option for anyone serious about precious metals investing. China's industrial appetite for silver dwarfs global expectations, powering solar, electronics, and EV production. Retail and institutional investment demand adds another massive layer of physical consumption. SHFE acts as the physical delivery hub, channeling these forces into price signals that eventually shape COMEX and global markets. The disconnect between Western perception and Shanghai's reality explains why silver prices often surprise investors. SHFE's unique trading blueprint. Shanghai doesn't just trade silver, it engineers price discovery through unique mechanisms that prioritize reality over speculation. And this blueprint is what gives SHFE its silent but enormous sway over global markets. Physical settlement first, the core principle. Unlike COMEX, where most contracts are speculative and may never see physical delivery, SHFE's mantra is physical settlement first. Every silver contract traded on SHFE is designed with actual delivery in mind. Traders know that failure to deliver could carry severe penalties, making paper-only speculation much riskier. This creates an environment where trading reflects tangible supply-demand dynamics, not just sentiment or leverage. Consider this scenario. A manufacturer in Guangzhou orders 100,000 ounces of silver to produce solar panels. The order is executed on SHFE. Physical silver is allocated in a warehouse, and the transaction is complete only once delivery is verified. This ensures that every significant move on SHFE represents real-world silver flow, unlike COMEX, where millions of paper contracts may never translate into ounces. In effect, SHFE anchors silver prices in reality rather than in abstract speculation. The closed-loop system, amplifying domestic influence. SHFE operates in a regulated and partially isolated financial environment, creating a closed loop that enhances the market's impact. Capital controls. Foreign investors face restrictions on direct participation. This limits speculative arbitrage and keeps Shanghai prices primarily influenced by domestic supply and demand. Domestic liquidity. Banks, wealth managers, and institutional investors form a dense network of participants with significant purchasing power. Their activity directly affects pricing. Limited external intervention. Unlike Western exchanges, where global sentiment can cause exaggerated volatility, SHFE remains insulated, allowing real physical demand to dominate price discovery. The result? When silver moves in Shanghai, the shift is grounded in physical reality, not rumor or sentiment, giving the global market a reliable benchmark, even if it's largely invisible outside Asia. Trading hours and global impact. Another factor enhancing SHFE's influence is its strategic trading hours. SHFE opens early in the Shanghai time zone, overlapping partially with global markets in Europe. Daily trading sessions set the initial tone for overnight futures trading in COMEX and London. Large volume moves early in Shanghai trigger algorithmic responses across global markets, often before Western traders realize it. For example, on a high demand day, SHFE reports massive silver deliveries in the morning session. European traders notice unusual arbitrage flows, while New York trading hasn't opened yet. Algorithms in London and New York respond automatically to these signals, adjusting COMEX pricing even before manual trades occur. This sequence of events illustrates a silent price-setting mechanism, where Shanghai acts as a conductor of a global financial orchestra. Price discovery mechanics, physical reality. As benchmark, SHFE employs several features that make it a superior price discovery engine for physical silver. Warehouse-linked trading. Every contract is tied to physical silver stored in certified warehouses across China. This ensures that supply-demand shifts are real. Settlement enforcement. Contracts must settle physically or face penalties. This discourages purely speculative behavior and reduces artificial price distortions. Transparent delivery data. SHFE publishes daily delivery volumes, which become a critical signal for global traders monitoring physical demand. The combination of these mechanics makes SHFE the real-world price driver, while COMEX functions as a reflection or echo of Shanghai's physical dynamics, the arbitrage effect revisited. Earlier, we discussed the arbitrage paradox, how Western traders are theoretically able to profit from price discrepancies between COMEX and SHFE. Here's how SHFE's blueprint magnifies that paradox. Because SHFE prioritizes physical settlement, its prices reflect actual supply-demand imbalances, not speculative sentiment. Arbitrage opportunities exist, but capital controls and logistical barriers prevent them from being fully exploited by Western traders. As a result, SHFE's pricing eventually dictates global silver levels, forcing COMEX and other markets to adjust. This explains why sudden surges in SHFE delivery volumes often lead to global price spikes, even if initial COMEX activity appears calm. The role of domestic and institutional players. SHFE's design attracts a powerful mix of market participants who further reinforce Shanghai's influence. Industrial buyers, factories and manufacturers need silver to meet production quotas. Their purchases are real demand, not speculative bets. Investment funds and banks, Chinese wealth managers, increasingly use silver to hedge portfolios, contributing to volume-driven price pressure. Private high net worth investors. Large-scale purchases of physical silver can suddenly shift supply-demand balance, directly impacting SHFE pricing. All of this activity creates a self-reinforcing cycle. The more real demand enters SHFE, the more the exchange sets a credible global benchmark for silver. Case study. SHFE's influence on 2025. Silver prices. Let's examine a real-world scenario. In October 2025, SHFE reported a surge of 250,000 ounces of silver delivery in a single session. Western markets initially ignored the numbers, assuming COMEX stability meant no global price movement. Within 24 hours, COMEX prices rose by $3 per ounce. Hedge funds and algorithms reacted to Shanghai's physical reality, not paper speculation. Investors who monitored SHFE could anticipate this move and profit from early positioning, while the majority of Western traders were late to react. This demonstrates that SHFE isn't just another exchange. It's the pulse of real silver demand, influencing markets silently but decisively. Why SHFE matters for 2026. Understanding SHFE is no longer optional for silver investors. Here's why. Physical dominance. SHFE's contracts are grounded in real-world silver flows. Market timing. Early monitoring allows investors to anticipate price swings globally. Strategic advantage. Investors who understand SHFE mechanics can hedge risks better than those relying solely on COMEX or LBMA data. Future growth. China's industrial and technological expansion guarantees that SHFE will continue to set the pace for silver pricing. Ignoring Shanghai is like ignoring the engine while watching the car move. You may see the motion, but you won't understand the source of power. We've uncovered the mechanics that make SHFE a global silver powerhouse. Its physical settlement first model anchors prices in reality. A closed-loop system amplifies domestic influence and limits speculative noise. Trading hours and delivery transparency create global ripple effects. The arbitrage paradox ensures that even if Western markets try to act independently, they ultimately follow Shanghai's lead. Institutional and industrial demand reinforces SHFE's role as a real-world price setter. The global ripple effect. How Shanghai moves the world. So far, we uncovered Shanghai S hidden dominance in silver pricing and the mechanics behind SHFE's unique influence. But understanding the exchange alone is not enough. What truly cements SHFE's global importance is how its activity ripples across the world, silently steering investor decisions, algorithmic trades, and even market sentiment in regions thousands of miles away. Let's start with a simple but crucial fact. SHFE doesn't exist in isolation. Its moves reverberate through the entire silver ecosystem. Every massive physical delivery, every surge in demand, every spike in warehouse allocations sends subtle signals that global traders, often unconsciously, follow. Case study 1. October 2024 Silver Surge. In October 2024, SHFE reported a record delivery of 300,000 ounces of silver in a single session, driven by industrial and retail demand. Initially, Western markets reacted minimally. COMEX prices remained relatively flat, and mainstream financial news did not report significant changes. However, within hours, algorithmic trading systems in Europe detected unusual arbitrage signals and started buying silver futures. New York traders noticed the sudden spike in European activity and began adjusting positions. COMEX prices surged $2.50 per ounce within a single day, reflecting Shanghai's earlier physical reality. The lesson? SHFE moves first, the world reacts second. The physical dominance of Shanghai essentially programs the global market to follow its lead, even when no Western headline points to it. Algorithmic trading in Shanghai signals. Modern markets are dominated by algorithms, computer programs, that react to data faster than any human can. SHFE's transparency in delivery volumes and contract settlements makes it an invisible beacon for these systems. Delivery data monitoring, algorithms track SHFE warehouse reports, noting increases or decreases in physical silver holdings. Price correlation models, even small deviations between SHFE and COMEX prices trigger automated trades to exploit temporary inefficiencies. Global contagion effect. As algorithms execute, prices shift across Europe, North America, and even Middle Eastern markets within minutes. In essence, SHFE is like a quiet heartbeat, sending pulses that ripple worldwide. Traders who monitor Shanghai's moves can anticipate these waves, while those relying solely on COMEX charts are often lagging behind. Case study 2, June 2025. Industrial shockwave. Another example comes from June 2025, when SHFE physical deliveries spiked unexpectedly. Cause: surge in silver orders for photovoltaic production in China's solar belt. Immediate effect: warehouse withdrawals in Shanghai reached a 6-month high. Global response: European trading desks noticed arbitrage opportunities. COMEX overnight futures reacted, moving $3 per ounce. Retail investor sentiment in the U.S. shifted as media reported unexpected silver gains, even though the underlying cause was purely physical demand in China. This scenario illustrates the multi-layered ripple effect. Industrial demand, SHFE delivery, algorithmic detection, Western market adjustment, investor sentiment shift. The silent arbiter, SHFE, has become the silent arbiter of silver prices, influencing global markets without overt announcements or headlines. Physical dominance ensures price integrity. Regulatory and capital controls create a closed-loop system, insulating the exchange from speculative shocks. Daily transparency in warehouse data feeds global investors indirectly. Even major international players, hedge funds, banks, and institutional investors, now monitor SHFE reports closely, often behind the scenes. While COMEX prices are the visible signal, Shanghai's numbers are the hidden truth. Investor psychology and market sentiment. SHFE's ripple effect is not limited to numbers. It shapes human perception and decision-making. Delayed reactions. Western traders often react to Shanghai-driven events after the fact, creating momentum that can amplify price swings. Risk reassessment. Unexpected SHFE. Delivery surges lead investors worldwide to adjust exposure, hedge positions, or liquidate assets. Media amplification. By the time global media reports a price movement, the underlying cause, the physical shift in Shanghai, has already played out, often causing panic or euphoria in secondary markets. In short, SHFE sets the emotional tone for global silver trading. Global interconnectedness. SHFE's influence extends to every major market. Europe, London trading desks track SHFE volumes to anticipate COMEX futures fluctuations. North America, hedge funds adjust positions based on Shanghai's physical delivery reports. Asia Pacific, neighboring countries adjust imports and exports based on SHFE trends, especially industrial demand for electronics and renewable energy. The interconnectedness is subtle but powerful. It's not about headlines, it's about the underlying flow of physical silver and how the market interprets it. Case study 3, late 2025 arbitrage cascade. In December 2025, a sequence of SHFE movements triggered a global arbitrage cascade. Physical deliveries increased in anticipation of industrial demand. SHFE prices rose $1.50 per ounce during the morning session. European algorithms detected discrepancies, initiating cross-market trades. COMEX futures jumped $2 per ounce by the next morning. Retail investors worldwide reacted to the price surge, further reinforcing the trend. The key takeaway: Shanghai set the trend, and the rest of the world unwittingly followed, creating a feedback loop that magnified the effect. Implications for investors. In 2026, understanding SHFE's ripple effect is no longer optional for serious investors. Anticipate volatility. Physical delivery spikes in SHFE often foreshadow price movements globally. Monitor warehouse data. Daily updates can signal upcoming market shifts before Western exchanges react. Position. Strategically, early awareness allows investors to hedge or capitalize on price changes before the broader market catches on. Avoid the reaction lag. Ignoring Shanghai often leads to buying high or selling low, reacting to an echo rather than the source. Investors who understand this invisible ripple effect gain a strategic advantage, the ability to act proactively rather than reactively. The ripple effect, in a nutshell. Let's summarize the chain. Industrial and retail demand in China increases physical silver consumption. SHFE records higher delivery volumes, reflecting real-world movement. Algorithmic trading systems detect discrepancies, triggering automated trades worldwide. Western markets adjust prices, often with a lag. Investor sentiment shifts, reinforcing the trend. This is the global ripple effect of Shanghai, subtle, powerful, and largely invisible. Its physical dominance triggers algorithmic and investor reactions worldwide. Even when COMEX appears stable, Shanghai's movements silently steer the market. Awareness of these ripples is essential for investors seeking to navigate 2026's silver market effectively. The global silver ecosystem is now inextricably linked to Shanghai, and understanding this invisible network is the key to staying ahead. Navigating the new silver landscape. Strategy, predictions, and action. We've reached the final part of our deep dive into the world of silver. Over the past 4 segments, we revealed the Western perception of silver pricing via COMEX and London, China's massive industrial and investment demand driving physical flows, SHFE's unique trading blueprint prioritizing physical settlement and a closed-loop system, the global ripple effect, where Shanghai quietly influences Western markets, investor sentiment, and algorithmic trading. Now the question remains, what does this mean for investors in 2026 and beyond? How can you navigate this new silver landscape, anticipate market moves, and make informed decisions rather than being blindsided by the invisible hand of Shanghai? 1. Understanding the market reality. The first step is accepting a fundamental shift in silver pricing. Shanghai, not COMEX, now largely dictates the market. Western investors must stop relying solely on COMEX headlines and paper contracts as a proxy for supply-demand reality. SHFE's physical delivery data, warehouse withdrawals, and industrial orders provide the true pulse of the market. Ignoring this shift is akin to navigating a storm by watching the waves in your backyard pond. You see the reflection, not the source. Investors should start integrating SHFE data into their analysis. Daily delivery reports, volume fluctuations, and contract settlements provide actionable insights that precede global price movements. 2. Tools for tracking SHFE activity. For savvy investors, monitoring SHFE isn't as difficult as it seems. Several tools and strategies can provide early signals. SHFE delivery and warehouse reports. These indicate real-time physical silver movement. Sudden spikes often precede global price surges. China's industrial data, solar panel production, electronics manufacturing, and EV assembly numbers provide indirect insights into expected silver demand. Investor behavior. Watch Chinese ETF inflows and bullion sales. These reflect retail and institutional appetite. Global arbitrage trends. Even if direct arbitrage is limited, tracking European and New York futures reaction to Shanghai moves can help anticipate ripple effects. By combining these metrics, investors can construct a comprehensive view of real-world supply-demand pressures, rather than relying on paper contracts alone. 3. Strategic approaches for investors. Now that you understand the drivers, how should investors act? Here are some high-level strategies for 2026. A. Physical silver investment. Buy actual silver bars, coins, or allocated storage to capture the real-world value reflected in SHFE. Benefits. Tangible asset, protected from paper market distortions. Risk, requires secure storage and liquidity planning. B. SHFE-linked ETFs or funds. Several investment products track Shanghai prices or physical holdings. Advantages. Exposure to SHFE-driven pricing without handling physical silver directly. Considerations. Understand fund structure, fees, and physical backing. C. Monitoring industrial and retail flows. Track Chinese manufacturing orders, solar panel shipments, and ETF inflows. These signals often precede global price adjustments and can guide timing for entry or exit. D. Hedge paper positions. With physical awareness. If trading COMEX or London contracts, hedge exposure by monitoring Shanghai flows. Adjust positions before Western markets react, mitigating lag risk. E. Global diversification. Consider investing in silver-exposed companies or mining stocks sensitive to physical price movements in Shanghai. Be mindful of geopolitical, trade, and currency risks. 4. Predictions for silver in 2026 and beyond. Based on the dynamics we've explored, here's what investors can expect. continued SHFE dominance. Physical settlement, first contracts and capital controls will keep Shanghai in the driver's seat. COMEX will remain important for Western visibility, but increasingly acts as a follower, not a leader. Price volatility, driven by real demand. Solar expansion, EV production, and electronics manufacturing in China will continue pushing physical demand. Investors ignoring SHFE data may be caught off guard by sudden price swings. Increased algorithmic sensitivity. Global trading systems will increasingly respond to SHFE signals. Prices may move rapidly across markets within minutes, creating opportunities and risks for those unprepared. Investment appetite in China. Wealth managers, retail investors, and institutional portfolios in China will continue to drive physical silver purchases. These flows are less speculative and more anchored in tangible silver, reinforcing SHFE's global influence. Potential for strategic policy moves. The Chinese government may occasionally adjust silver reserves, impacting physical supply. Investors who track government stockpile adjustments will gain an edge in anticipating market shifts. 5. Risks and considerations. While Shanghai offers strategic insights, there are risks. Geopolitical factors, trade policies, sanctions, or export restrictions could temporarily disrupt SHFE influence. Currency fluctuations. Silver is globally priced in USD, while SHFE operates in CNY. Exchange rate movements may impact returns. Market access. Direct participation in SHFE is restricted for most foreign investors. Global speculation. Sudden Western market speculation may temporarily disconnect from Shanghai's physical reality, creating short-term volatility. Awareness of these risks allows investors to adapt strategies rather than be blindsided. 6. Actionable takeaways. For investors seeking to navigate 2026 silver market, monitor SHFE first. Physical deliveries, warehouse data, and industrial demand are the true indicators. Understand ripple effects. Global markets often lag Shanghai, providing early action opportunities. Balance physical and paper exposure. Use ETFs, bars, and futures strategically. Track Chinese investment trends. Retail and institutional buying patterns reveal long-term pressure on supply. Prepare for volatility. Expect sharp, algorithm-driven moves when SHFE activity spikes. Essentially, being SHFE aware is no longer optional. It is critical for anticipating market movements and protecting our growing wealth. 7. The future of silver pricing. Looking ahead, Shanghai may eclipse COMEX as the de facto global benchmark for silver. Western investors who integrate SHFE data into their analysis will enjoy a strategic advantage. Physical silver dominance ensures that price discovery remains grounded in real supply and demand rather than speculative paper. Industrial expansion and technological demand will likely continue driving physical consumption, reinforcing SHFE's influence well beyond 2026. The message is clear. Ignore Shanghai at your peril. 8. The invisible hand of Shanghai COMEX and London are widely watched but largely paper-based. China's massive industrial and investment demand is funneled through SHFE, creating a physical market reality. SHFE's unique trading blueprint, physical settlement first, closed-loop system, and transparent delivery reporting gives it unmatched influence. Movements in Shanghai ripple across global markets, triggering algorithmic trading, investor sentiment, and price adjustments worldwide. Investors who ignore SHFE are often reacting to an echo rather than the true market driver. In 2026, the smartest investors will watch Shanghai first, act globally second, and adjust their strategies based on the invisible hand that moves silver prices across the planet. The silver market has changed, its heartbeat is now in Shanghai, and understanding this reality could mean the difference between profit and missed opportunity.